If you're watching the video feed of this deep dive right now, you can actually see the digital backdrop behind us transforming. It's shifting from this towering, intricate cityscape into this glowing digital matrix of financial architecture. Data streams are literally building skyscrapers of code right in front of us.
It's a pretty incredible visual, honestly.
Yeah, and that visual is exactly what we're dissecting today, because I want you to think about something for a second. Have you ever noticed how global markets just completely lose their collective minds over a single press conference?
Oh, absolutely. It's clockwork.
Right, you know the drill. A tiny rate hike surprises everyone. A CPI print flashes red on the terminal. Panic ensues. Volatility spikes. The news networks bring out the bold graphics. The pundits start shouting. And everyone scrambles to adjust their portfolios based on, I don't know, a few sentences spoken at a podium.
It's a frantic, endless cycle.
Yeah.
It completely consumes an unbelievable amount of energy and attention from participants across the entire globe.
Yeah. Exactly. Which leads to some massive rhetorical questions. Why are we so obsessed with the news ticker? Why do we treat every single economic announcement like it's the finale of a blockbuster movie? And more importantly, what if we've been conditioned to look at the entirely wrong thing?
That is the big question.
Welcome to the deep dive. We are thrilled to have you with us today because our mission today is ambitious. We are going to completely rewire how you look at the global financial system. We're tearing down the illusion of breaking news. Okay, let's unpack this. The foundational thesis we're exploring today is that monetary policy is not a sequence of announcements.
Right.
It's not a headline. It is the architectural framework that dictates how every single financial participant behaves.
That is the absolute perfect way to frame it. Markets are essentially trained to react to monetary policy as if it were breaking news. A press conference disappoints or forward guidance gets tweaked, and the immediate reaction is to trade the surprise.
Always trade the surprise.
But this framing is incredibly shallow. Monetary policy is the invisible architecture within which the entire market operates. It determines how risk is priced, it dictates how capital is allocated, it tells participants how leverage should be constructed, it defines how liquidity is going to behave over long periods of time.
So it's the environment itself.
Exactly. News only moves price briefly. Architecture shapes behavior persistently.
That sounds great in theory, but I have to play devil's advocate here for a second.
Yeah.
If I'm watching the S&P 500 drop 3% in 10 minutes after a rate hike announcement, that does not feel brief to the person losing money. It feels incredibly permanent in that moment.
Sure, the pain is real.
Yeah, so how do you convince an investor that the drop is just noise and not the actual foundation crumbling?
That is the critical distinction we have to make. We are talking about the event-driven illusion versus the architectural reality. Let's look at modern market commentary. It reduces everything to these fleeting moments. The FOMC statement drops at 2 p.m. Someone tweaks the wording of their forward guidance from may to will. Everyone treats these tiny events as the ultimate catalysts for market direction.
But the real story is...
What's fascinating here is that the announcement itself is almost never the actual cause of the market's long-term movement.
Oh, okay.
The underlying structural effect was already embedded in the system long before the press conference even happened. The announcement is just a catalyst. It is not the cause.
Okay, break that down for me. Catalyst versus cause. I want to make sure I really get this.
Think about it like a stress test on a building. If a strong gust of wind hits a skyscraper and a window shatters, the wind was the catalyst. It triggered the break. But the cause of the failure was the architectural design of the window frame. It was fundamentally flawed or maybe weakened over time. The underlying structure dictates the outcome. The wind just revealed the structural reality.
I love that analogy. The wind is the headline. The architecture is the policy. The headline just exposes what the policy has already built. And this distinction is exactly what separates two very different types of market participants.
Absolutely.
If you want to truly understand markets, you have to evolve. You have to move away from being an event trader who just reacts to the noise of the wind. You need to become a regime thinker who actually understands the building's blueprint.
Precisely. Event traders are constantly exhausted. They are always reacting to the last piece of data. They live in a state of perpetual adrenaline.
Yeah, just staring at screens all day, waiting for a red headline.
Exactly. Regime thinkers are calm. They understand the environment they are operating in. They know how the building is designed to sway in the wind. To get to that level of understanding, we have to clearly distinguish between tactical actions and structural regimes. These are completely different concepts that get conflated all the time on financial television.
Let's define those terms, because I think people use them interchangeably all the time. Let's start with tactical actions. We'll call these policy actions. These are the things that make the headlines, right? A rate hike, a rate cut, a sudden expansion of a central bank's balance sheet. These are adjustments, and they create a tremendous amount of noise.
They absolutely do. Actions shift immediate expectations. They generate short-term volatility. But here is the critical piece to understand about that 3% drop you mentioned earlier. The immediate effect of a policy action almost always reflects market positioning rather than a true structural change.
Wait, explain market positioning in this context. What does that actually mean on the ground?
Market positioning refers to how heavily investors are leaning in one direction. Imagine a boat where everyone runs to the left side because they think the view is better.
Okay, leaning hard to port.
Right. If a small wave hits the right side, a tactical action, the boat rocks violently. Not because the wave was a tsunami, but because the boat was fundamentally unbalanced. If the market is heavily positioned for a rate cut and the central bank does nothing, you get a violent unwinding of those positions, people scrambling to get back to the middle of the boat. That is the noise.
So it's a positioning shakeout. The wave didn't sink the boat. The passengers just panicked and tripped over each other. It is not a new blueprint for the ocean. Now contrast that with policy regimes. This is where the real power lies.
A regime is the prolonged, sustained environment created by a persistent policy direction. We are talking about multi-year easing cycles, prolonged tightening phases, extended environments of financial repression, fundamental shifts in inflation tolerance.
Big picture stuff.
Very big picture. These regimes do not last for days or weeks. They last for years, sometimes decades. And they're so powerful because they do something fundamental to the human psychology of investing. They alter the definition of what is rational.
I want to spend some real time on that point, because I think it's the psychological key to this whole deep dive. A regime redefines what is rational for an investor to do. It literally changes the rules of the game while you are playing it. Can you give me a tangible example of how a regime changes human behavior?
It changes the incentive structure completely. Let's look at a regime of 0% interest rates and massive liquidity. In that specific architecture, the rational thing to do is to borrow as much money as you possibly can and buy risky assets.
Just lever up.
Exactly. In fact, in that regime, holding cash in a savings account is deeply irrational. You are actively losing purchasing power to inflation, and you are missing out on asset appreciation. The architecture punishes the saver and rewards the speculator. It's kind of like buying a house. If my mortgage rate is 2%, I am buying the biggest house I can possibly afford. The money is virtually free. I'd be crazy not to lock that in for 30 years.
Yes.
But if the regime shifts and suddenly my mortgage rate is 8%, I am very happy renting my tiny apartment. The house itself didn't change. The physical bricks are exactly the same, but my incentives completely inverted.
That is a perfect translation of the concept. The house is the asset, the interest rate is the architecture. If the global macro regime shifts to high interest rates and tight liquidity, suddenly holding cash is incredibly rational. It becomes a high-yielding, safe asset, and carrying heavy leverage. It becomes suicidal. The definition of a smart investment morphs entirely based on the regime.
Let's zoom out for a second,
Yep.
because we need to look at the master blueprint. How does this architecture actually force the hands of massive institutional participants? It all starts with the cost of capital and incentive design. In the historical data, there is this concept of the risk-free rate acting as the ultimate structural anchor.
It is the anchor for everything in finance. At its absolute core, monetary policy defines the cost of capital. The policy rate, what we often call risk-free rate, usually represented by government treasury yields, anchors the entire asset pricing framework for the global economy. Every single valuation model, every assessment of risk, every corporate budget begins with that baseline number.
Let's get into the mechanics of that, because it sounds academic, but it drives trillions of dollars. When we talk about discount rates and valuation models, how does this actually work in practice? And please explain it like I don't have a PhD in mathematics.
Absolutely. It comes down to how we value future cash flows. The value of an investment today is simply the present value of all the cash it will generate in the future. To figure out that present value, you have to discount those future cash flows back to today. Use an interest rate to do that.
Why do I have to discount it, though? Why isn't a future dollar just worth $1?
Because a dollar today is worth more than a dollar 10 years from now. You could invest the dollar today and earn interest on it. So a dollar promised to you in 10 years has to be discounted to figure out what it is worth right now. When the architectural regime compresses interest rates towards zero, that discount rate plummets.
And what does that do to the math?
Mathematically, a lower discount rate makes future cash flows far more valuable today. The penalty for waiting is gone. This structurally increases the relative attractiveness of long-duration assets. Think about a wildly speculative tech company that is burning cash today, but promises to make $1 billion 10 years from now.
Right, because when rates are at zero, investors don't care that they have to wait 10 years. The penalty for waiting 10 years for return is virtually non-existent, so they bid the stock price up to the moon.
Exactly. But when policy tightens and rates go up, that discount rate expands. Suddenly, waiting 10 years for a return is heavily penalized by the math. If you can get 5% risk-free from the government today, why would you take a massive risk on a company that might not pay out for a decade? You wouldn't. The math forces a repricing across the entire risk spectrum, and this leads right into how risk premia and leverage behave at the extremes.
Okay, before we go further, define risk premium. I see that term constantly. What is a risk premium?
A risk premium is simply the extra return you demand for taking on risk. If a perfectly safe government bond pays 4%, and you're looking at a slightly risky corporate bond, you might demand 6% to buy it. That extra 2% is your risk premium. It is your compensation for the possibility that a corporation might go bankrupt.
Got it. So let's look at the low rate extreme first. What happens to that premium when the architecture forces rates to zero?
Low-rate environments compress risk premia. What that means is the extra return you get for taking on risk becomes very small. Investors are starved for yield everywhere. They are desperate. So what does the architecture incentivize them to do? It practically begs them to use leverage.
Because they can't get the returns they need naturally.
Exactly. If you can only get a 2% return on an asset, but you can borrow money at 0%, you lever up that asset. You borrow 5 times your initial capital, buy more of the asset, and suddenly your return is 10%. You look like a genius. But you didn't do it because you're a genius. The architecture created the absolute incentive for that behavior.
And then we look at the high rate extreme. The regime shifts. High rate environments expand those required returns. They severely penalize that long-term speculative duration exposure we talked about. Leverage goes from being a handy tool for return enhancement to a weapon of mass destruction pointed directly at your portfolio. The cost to service all that debt you took on suddenly explodes.
Yes. Let's bring this to life with real-world institutional examples. Think about a massive state pension fund. These funds manage the retirement money for teachers, firefighters, and police officers. They have very strict, legally binding mandates. They need to generate, say, a 7% annualized return to meet their obligations to those retirees.
If they don't hit 7%, the state goes bankrupt, or the retirees just don't get paid. The pressure is immense.
Right. And if the monetary architecture sets the risk-free rate at 5%, that pension fund manager has a relatively easy job. They can hit their 7% target by buying safe, plain vanilla government and high-grade corporate bonds. They sleep well at night. They don't need to take on massive risk.
Makes sense.
But if the architecture shifts and the risk-free rate is pinned at 0% for a decade, that pension fund is suddenly in a full-blown crisis.
Because they still need 7%. The mandate didn't change just because the central bank cut rates.
Precisely. The mandate is fixed. The architecture forced their hand. They cannot achieve their mandate without moving aggressively out the risk curve. They have to allocate billions of dollars to private equity. They have to dive into venture capital. They have to buy complex, illiquid derivatives. They do not want to do this. They're forced to do this.
They adjust their portfolio risk budgets. They change their institutional hurdle rates. And it trickles down. Corporate entities alter their leverage strategies to issue cheap debt and buy back their own stock. And here's the so what for you listening right now. These participants did not change their behavior because the central bank held a press conference and explicitly told them to buy private equity. They didn't listen to a speech and say, wow, great idea.
No, they didn't. They acted because the architecture of the system made any other decision incredibly inefficient. And in the case of the pension fund, mathematically impossible. Policy does not instruct markets. It redesigns their incentives system-wide. It is a sustained recalibration of rational behavior. This is not a reaction to a single announcement.
Now, here's where it gets interesting. Because we have to talk about the plumbing of the system. We have to talk about the liquidity architecture and volatility. There is a huge myth out there about what liquidity actually is. I think if you ask the average person on the street, they think liquidity is just central banks printing physical pallets of cash and injecting it directly into the stock market to make prices go up.
That is a very common and very dangerous misconception. Policy shapes liquidity, but not by just handing out cash to buy stocks.
Yeah.
It shapes liquidity by altering the system's absorption capacity.
Absorption capacity. That sounds like a sponge.
That is exactly the right visual. Think of the global financial system like a giant sponge.
Yeah.
Quantitative easing, or QE, increases the elasticity of financial conditions. It
Yeah.
alters the availability of collateral in the system. It compresses yields. This architectural environment makes absorbing systemic risk much easier. The sponge gets bigger, it gets softer, it can absorb a massive spill without leaking.
It changes how imbalances are handled system-wide. But let's dive into the actual funding conditions, the day-to-day plumbing. We hear terms like short-term rates, repo market stability, and interbank confidence. These are the pipes of the financial system. But wait, before we go further, what is a repo market? I see that on financial Twitter. People lose their minds over repo spikes. But for someone not staring at a terminal, what actually is it?
The repo market, or repurchase agreement market, is essentially the pawn shop of the global financial system. But for banks, it is how banks lend massive amounts of money to each other overnight. A bank needs cash for 24 hours. They hand over a safe asset, like a treasury bond, to another bank as collateral. They get the cash. The next day, they buy the bond back for a tiny bit more money. That is the interest. It is the absolute bedrock of daily financial plumbing.
Okay, so if banks are lending to each other every single night, those pipes are highly sensitive to policy.
Incredibly sensitive. When funding conditions are stable and predictable, the market has tremendous absorption capacity. The sponge is working. If a shock hits the system, a geopolitical event, a bank failure, the market absorbs it easily. Why? Because participants have structural confidence in the functionality of balance sheets. They know they can access funding in the repo market if they need it. Banks trust each other.
But what happens when the pipes get clogged? What happens when banks suddenly don't trust the collateral the other bank is holding?
When funding becomes uncertain, that absorption capacity vanishes instantly. The sponge turns into a brick. And that is when violent repricing accelerates across the globe. Liquidity isn't just about the mathematical availability of capital. It is about structural confidence. If the confidence in the plumbing breaks, the entire building shakes.
Which brings us to the ultimate regulator of the market, the thing that every trader watches, volatility. Why does volatility completely vanish for years, lulling everyone to sleep, and then suddenly explode out of nowhere?
Volatility is profoundly influenced by the monetary architecture. It is not just random market noise. We can break this down into two distinct states: suppression and release.
Let's start with suppression, because this is the environment we lived in for a very, very long time. Post-2008, it felt like markets just went up in a straight line forever.
Under volatility suppression, central banks are perceived by the market as the ultimate stabilizers. The market assumes a backstop exists. There is a deeply ingrained belief that if things get bad, if the market drops 20%, policymakers will panic, step in, cut rates, and rescue the architecture. We often call this the central bank put.
It's like having an insurance policy that you don't even have to pay premiums for.
Exactly. Because of that structural confidence, risk-taking explodes. Volatility compresses to historic lows. The system believes the downside is explicitly insured by the central bank. Why would you panic and sell if you know the central bank is going to bail out the market? You don't. You hold. And the lack of selling creates a lack of volatility.
But then we have the release phase. The architecture shifts. The insurance policy gets canceled.
Yes. The release happens when inflation uncertainty rises, or when the credibility of the policy itself starts to weaken. If inflation is at 9%, the central bank cannot step in and cut rates just because the stock market is dropping. They are trapped. The stabilizing architecture begins to erode. And this is crucial for listeners to grasp. Markets are not just repricing the assets in front of them, they are repricing the reliability of the policy itself.
The backstop is questioned.
When that structural confidence breaks, volatility expands violently. Volatility is often just a symptom of an architectural transition. It is the sound of the market realizing the rules have changed.
This circles back perfectly to the illusion of the breaking news surprise we talked about in the intro. We hear it all the time on financial television. The anchor looks at the camera and says, "Oh, equities are rallying today on a dovish pivot." Or, "The market is down today because of a hawkish surprise."
It is an illusion. Most of those so-called surprises are simply reflections of positioning misalignment, not a structural shock. If the architecture of the market has been drifting toward tighter conditions for 6 months, if the repo markets are tight, if bond yields are slowly climbing, and then an announcement finally confirms it, the news didn't cause the shift. The news simply catalyzed the realization that the market was positioned wrong for the architecture that was already being built. News is rarely causal. It is catalytic.
So what does this all mean? Let's trace the global ripple effect of this structural influence. Because no asset class is independent of this architecture. Everything is integrated system-wide. Let's break down how different asset classes respond to these regime shifts. I want to spend some real time here because this is where the theory hits the portfolio. Let's start with equities.
Equities are highly sensitive to the cost of capital. As we discussed with discount rates, low-rate regimes strongly encourage multiple expansion.
Let me stop you there. Multiple expansion. We need to define that. What is a multiple and why does it expand?
A multiple is usually the price-to-earnings ratio, the PE ratio. It is how much you are willing to pay for $1 of a company's earnings. If a company earns $1 a share and the stock is $20, the multiple is 20. In a low-rate regime, because you have nowhere else to put your money to get a return, you might be willing to pay $40 for that same $1 of earnings. The earnings didn't change. Your willingness to pay more, the expansion of the multiple changed entirely because the architecture forced you to take more risk.
Got it. So the architecture forces me to overpay for earnings.
Yes. And this naturally favors growth leadership. Companies that promise massive profits in the distant future. Tech, biotech, disruptive innovation. Because the discount rate is zero, those future profits look incredibly valuable today. But when the regime shifts to tightening and rates go up, those multiples compress violently. You are no longer willing to pay $40 for $1 of earnings. Maybe you only want to pay $15. The architecture forces a pivot away from speculative growth. Investors suddenly demand companies with immediate, durable, present-day cash flows. The leadership of the entire stock market flips. It goes from tech to utilities, energy, and value stocks because the incentives changed.
That makes perfect sense. What about fixed income, the bond market? Everyone always says the bond market is the smart money. The bond traders figure things out months before the equity guys do. Why is that?
The bond market is pure architecture. While equity markets can get caught up in narratives and emotion, the bond market is essentially just math and policy expectations. Policy completely defines term premia behavior.
And term premia is the premium investors demand for locking up their money for longer periods.
Correct. If you lend the government money for 10 years instead of 2 years, you generally want a higher interest rate because there is more time for things to go wrong. Inflation could spike. That extra yield is the term premium. When inflation is stable and policy is predictable, yield curves are generally anchored and upward sloping. You get paid more for longer lockups.
But what happens when the architecture fractures?
When policy becomes uncertain or the regime transitions, you see violent moves in the term structure. Yield curves steepen dramatically, or they invert. An inverted yield curve where a 2-year bond pays more than a 10-year bond is the bond market screaming that the near-term architecture is completely unstable and the economic trouble is coming. The bond market is constantly mapping the changing blueprint of the policy regime.
Let's move to foreign exchange, the FX markets. Currencies. This is where the global nature of this deep dive becomes so apparent. We are talking about relative policy divergence driving capital across borders. Give me a scenario. Let's say I am an institutional investor in Japan looking at United States interest rates. How does this architecture affect my decisions?
It dictates everything. Capital is constantly searching for the optimal environment. It is like water flowing downhill. Let's use your example. If the United States Central Bank is maintaining a tight, high-rate architecture, say, rates are at 5%, and the Japanese central bank is running a loose, low-rate architecture, holding rates at 0, capital will flow relentlessly from the low-rate jurisdiction to the high-rate one.
Because if I am in Japan, why would I accept 0% on my money when I can just convert my yen to dollars and get 5% in U.S. treasuries?
Exactly. You sell your yen, you buy dollars. Multiply that individual decision by trillions of dollars across global hedge funds, pension funds, and sovereign wealth funds. The result is a massive devaluation of the yen and a surge in the strength of the dollar. This relative divergence drives multi-month, sometimes multi-year, currency campaigns. These massive, sweeping moves in FX are born entirely from policy regime differentials. It is capital responding to the architectural design of different nations.
And finally, credit markets. Corporate debt. This is often called the ultimate barometer of risk tolerance.
Credit spreads tell the story of absorption capacity perfectly. A credit spread is the difference in yield between a risky corporate bond and a risk-free government bond. Let's say the government bond pays 4%. A junk-rated corporate bond might pay 8%. The spread is 4%. When the policy regime supports risk tolerance and provides ample liquidity, credit spreads compress. Investors are so desperate for yield that they will lend to very risky corporations for only 5% instead of 8. The spread shrinks to 1%.
They are basically saying, I am not worried about you going bankrupt because the central bank is pumping the system full of liquidity.
Precisely. But when policy tightens and chokes off that absorption capacity, spreads expand violently. Capital flees from risk. Suddenly, investors demand 12% to lend to that same risky corporation. Corporations suddenly find it incredibly expensive or even impossible to fund themselves.
Yeah.
Bankruptcies rise. The architecture choked off their oxygen.
It is all connected. No asset class is safe from this. Equities, bonds, currencies, corporate debt, they're all just different expressions of the same underlying master blueprint. To really hammer this home, we need to look at the blueprints of the past. We need to ground this heavy theory in historical reality.
If we connect this to the bigger picture, historical case studies provide the ultimate proof of how this works. Looking back at the data, let's analyze 3 distinct eras where the architecture radically changed. These are moments where the building was entirely redesigned.
Let's do it. Case study 1 is the post-2008 quantitative easing era. We all remember the setup. The global financial crisis, Lehman Brothers collapses, the housing market implodes, the entire global banking system is teetering on the edge of total failure. It was sheer panic. The Federal Reserve steps in and initiates something we'd never really seen before on this scale. Unprecedented quantitative easing. They just started buying trillions of dollars of bonds. I remember the media narrative at the time. Financial television was obsessed with every single QE announcement. Every month, analysts were parsing sentences to guess how many billions of bonds the Fed would buy. 40 billion, 80 billion. But based on everything we have discussed, all of that guessing was just noise, wasn't it?
It was absolute noise. They were hyper-focusing on the tactical actions. They were watching the wind. The reality, the thing that actually dictated the next decade of wealth creation was the architectural impact. By anchoring risk-free rates near zero for years and flooding the sponge with liquidity, the Fed fundamentally altered the market's foundation.
How did Wall Street adapt to this new blueprint? Because it wasn't just a temporary fix. It became the new normal.
It changed the psychology of an entire generation of investors. Duration assets, like those long-term tech stocks we talked about, were structurally repriced higher. Volatility was completely compressed because the market learned and truly believed that the central bank put was permanent. If the market dropped, the Fed would just print more money. Corporate leverage soared. Why wouldn't a CEO borrow $1 billion at 1% interest to buy back his own company's stock? The math was irresistible. Equity multiples expanded massively.
It created a relentless bull market.
Yes, and it is crucial to understand that this bull market was not the result of a single policy decision on a Tuesday afternoon in 2009. It was an entirely new regime of suppressed discount rates that lasted for years. The market completely reorganized itself around a zero cost of capital. The architecture aggressively incentivized massive risk-taking and severely punished anyone conservative enough to hold cash.
That regime lasted for a long time. People got very comfortable. They thought it would never end. And then we have case study 2, the 2013 taper tantrum. This is a legendary moment in market history. Set the stage for us. What happened?
It was May 2013. Ben Bernanke was the chair of the Federal Reserve. He was giving a relatively routine testimony before Congress, and he simply suggested, almost in passing, that the pace of their monthly asset purchases might slow down at some point in the future. He didn't say they were stopping QE. He didn't say they were raising interest rates. He just said they might taper the pace of buying. They might buy a little bit less every month.
And markets reacted with incredible, completely disproportionate violence. I remember watching the screens. It was a bloodbath.
It was a global shockwave.
Yeah.
And it proves our central thesis perfectly. Why was the reaction so violent to a mere suggestion? A hint. It wasn't about the specific mathematical amount of reduced asset purchases in the near term. Whether they bought 10 billion less didn't actually matter to the daily plumbing.
Then what caused the panic?
It was a structural confidence shock. The market suddenly realized that the architecture of perpetual infinite liquidity expansion was questionable. The foundational belief of the entire regime that the Fed would never, ever step away was challenged.
The psychological backstop cracked?
Exactly. And the repricing was instant. Duration risk repriced violently. But the most fascinating part was the global ripple effect. Emerging market capital flows, which had flooded out of the U.S. seeking higher yield in places like Brazil and India during the zero-rate regime, suddenly reversed. Capital fled back to the core. The U.S. dollar spiked. Emerging market currencies collapsed. Volatility expanded rapidly.
All because of one sentence in a congressional hearing?
But again, the sentence was the catalyst, not the cause. The cause was that the global financial system had built a massive, highly leveraged structure on top of a foundation of infinite liquidity. When Bernanke suggested the foundation might not be infinite, the structure shook. The reaction was entirely about structural confidence in the regime, not the speech itself.
Which brings us to case study 3, the most recent and perhaps the most painful for many people listening. The 2022 tightening shock. The environment completely flips. We have a massive surge in inflation. Supply chains are broken. Trillions of dollars of fiscal stimulus are sloshing around. The Federal Reserve is forced into its most aggressive tightening cycle in decades. Rate hike after rate hike. 75 basis points at a time. But again, the story wasn't just the tactical hikes, was it?
No. The story was the complete violent destruction of the prior architecture. Markets didn't just react to the individual hikes. They didn't just tweak their models. They systematically repriced the entire globe because the underlying incentive framework that had existed for over a decade was being dismantled brick by brick.
Walk me through what that demolition looked like across the asset classes.
It was textbook regime change. Discount rates across equities exploded upward. Because the risk-free rate went from 0 to 5% in a matter of months, the math for those long-duration tech companies broke. High multiple growth stocks were crushed. Term premia in bonds shifted violently. The bond market suffered one of its worst years in recorded history. Cross-border capital flows realigned as the U.S. dollar surged to generational highs, crushing foreign currencies. Credit spreads widened as the absorption capacity of the market dried up, and the volatility regime completely reset.
The era of the central bank backstop was dead. Because inflation was high, the Fed couldn't rescue the stock market. Leverage went from being a structural advantage, a tool to get rich, to an existential threat. If you had floating rate debt in 2022, you were fighting for your life. Duration went from being a safe haven to being highly vulnerable. Liquidity conditions tightened structurally across the board. The architectural shift drove a massive regime change. It wasn't the press conferences that caused the pain. It was the fact that the cost of capital fundamentally mathematically changed.
This raises an important question. If markets reprice this violently when policy architecture shifts, because incentives change system-wide, how should individual participants actually navigate this? How do you survive transitions from easing to tightening, or from inflation suppression to inflation tolerance?
This is exactly what we need to cover next. We are talking directly to you, the listener. Whether you are a casual observer just trying to understand the news, managing your own 401k retirement account, or trading actively every day, if you have spent your time trading headlines, waiting for CPI prints and FOMC statements to decide your next move, how do you fix your strategy? How do you change your playbook to become a regime thinker?
Based on the historical data and the mechanics we've discussed, there's a clear set of rules for adapting to this reality. Rule number 1 is the most critical and the hardest for people to accept. Stop trading headlines. You have to break the addiction to the news ticker. The announcements matter far less than the direction of the regime. You have to focus your attention on sustained incentive changes, not breaking news.
It's hard, though. The financial media industrial complex is designed to make you feel like every headline is a life or death moment for your money.
It is designed for engagement, not for structural analysis. Remember, speeches may move price for a few hours or a few days, but structure is what actually moves capital over months and years.
Rule number 2, identify architectural drift. This requires looking away from the front page. If I am not looking at the CNBC breaking news banner, where should I be looking instead? How does a normal person track this drift?
You need to watch the plumbing. You don't need a Bloomberg terminal to look at the yield curve. Pay close attention to term structures in the bond market. Look at the spread between the 2-year Treasury and the 10-year Treasury. Is it steepening? Is it inverting? That tells you what the structural confidence of the market is. Monitor volatility regimes. Are credit spreads behaving consistently with equity multiples? If the stock market is hitting all-time highs, but junk bond yields are quietly spiking, that is a massive architectural divergence. The credit market is warning you that absorption capacity is shrinking even while equity traders are still partying.
So the underlying indicators whisper the truth about structural transitions long before the financial headlines start screaming about them. They reveal the drift in the architecture.
Exactly. Rule number 3, respect lag effects. This is a tough one for people used to instant gratification. We live in a world of one-click shipping and instant streaming, but macroeconomics does not work that way.
It is a massive cargo ship, not a speedboat.
Precisely. Architectural changes do not happen overnight. They unfold over quarters, sometimes years.
If a central bank fundamentally shifts its regime and raises rates by 3%, the immediate volatility in the stock market does not equal the full structural impact.
It takes time for that higher interest rate to actually hurt the economy.
Yes. The true impact takes time to work its way through corporate balance sheets as companies have to refinance their debt at higher rates. It takes time to alter consumer behavior as mortgages become unaffordable and credit card payments spike. It takes time for institutional asset allocation models to slowly shift billions of dollars from stocks to bonds. You have to have the patience to respect that lag. Just because the economy didn't crash the day after the rate hike doesn't mean the architecture hasn't changed.
And finally, rule number 4, line campaign thinking. This is the antidote to day trading. You have to think in multi-month or multi-year campaigns.
You have to understand that the major trends you see, a massive 5-year bull market in equities, a structural widening of credit spreads that lasts for a year, or a sustained multi-month rally in the US dollar, these are not random events. They're not series of lucky coin flips. They're simply downstream expressions of the master incentive design. If you understand the policy regime, you could align your investments with the underlying current of capital, rather than fighting the tide based on yesterday's news.
You want to be riding the structural wave, not trying to paddle against it because of a single headline. That is a masterclass in market mechanics. We have covered a tremendous amount of ground today. I want to synthesize all of this. Let's summarize the big takeaway of this deep dive. If you take nothing else away from this hour, remember this. The global financial markets operate inside a carefully, deliberately designed framework. Monetary policy is not a sequence of breaking news alerts. It is the invisible architecture of the system. Tactical actions, the things that make the headlines, create noise and temporary volatility. They are the wind hitting the skyscraper. But structural regimes create sustained behavior. They define what is rational. They dictate the ultimate cost of capital. They shape the absorption capacity of the entire global sponge.
And those who understand that architecture are trading reality. They are operating with a clear map of the terrain. Those who remain hyper-focused on every single announcement, every dot plot update, every press conference, they are simply trading the noise. They are constantly reacting, constantly exhausted, and constantly surprised by the shifts in the tide. Ultimately, structure dictates the flow of capital, and capital is what defines the regime.
I want to leave you with one final thought. The next great market regime change, the one that will define the next decade of returns, the one that will dictate whether your portfolio thrives or struggles, will not be announced with a red breaking news banner on television. It will not be handed to you neatly packaged in a press release. It is being quietly built right now. It is being constructed in the day-to-day plumbing of the funding markets, in the slow, persistent drift of term structures, and in the evolving incentives of global capital allocation. The blueprints for the next decade are already being drawn.
The real question is, now that you understand how to look at the underlying structure, now that you know how to read those blueprints and ignore the noise of the wind, will you be able to see the new architecture forming before the rest of the world even realizes that the building has changed?
That is the challenge we leave you with today. Thank you so much for joining us on this deep dive. We hope this fundamentally rewires how you view the relentless flow of financial information. Stop watching the wind and start studying the architecture. We will see you next time.